Hello, bold investors. It's your Dividend Uncle bringing you a tale of highs and lows in the world of investing. We're diving deep into my journey with CapitaLand China Trust, or CLCT, which saw a sharp 33% decline over the last year. In the thick of the COVID-19 crisis in 2020 when shares hit below $1, I made a significant move, believing we'd hit rock bottom. The market seemed to agree, briefly pushing prices up thereafter, a nod to my predictions. I even got my family on board. But now, with values dipping below 80 cents, I'm looking at a daunting $21,000 paper loss, a truly rollercoaster ride, and an emotional one. The big question looms: what's my next move? Throw in the towel, double down, or wait it out? Beyond the immediate challenge, could this situation present a rare opportunity for savvy investors? Let's dive into this journey, exploring not just valuable insights but potential openings in the market that come once in a blue moon. In Q4 2023, CapitaLand China Trust's performance was marked by a deterioration in the logistics properties, balanced against continued recovery in the retail sector. This period saw a lift in net property income, or NPI, by 5.3% year-on-year, in RMB terms, driven by improved retail conditions and the completion of asset enhancement initiatives, or AEI, despite lower contributions from new economy assets. However, the strong Singapore dollar and higher interest costs, the twin monsters terrorizing REITs over the past years, led the charge to a 10.1% decrease in distribution per unit, DPU, for FY 2023 compared to FY 2022. Let's break down the key risks facing CapitaLand China Trust with some hard numbers. First, the logistics segment, which represents about 7% of CapitaLand China Trust's assets, saw occupancy dip to 82.0% with negative rental reversions of -20.5%. This stark decline underscores the challenges in maintaining occupancy and rental rates amidst increasing market supply and competition. Next, the broader market conditions in China affecting business sentiments, investors' outlook and consumer spending. While specifics on performance metrics weren't detailed, the overall sentiment suggests these assets are struggling to meet expectations in a rapidly evolving market landscape. Lastly, currency volatility. The strong Singapore dollar against the RMB has diluted returns, directly impacting CapitaLand China Trust's bottom line. For example, despite revenue and NPI growth in RMB terms, the conversion to SGD terms saw declines, highlighting the significant impact of forex movements on earnings. The Dividend Uncle's take. So, what's my take, especially after a hefty $21,000 paper loss with CapitaLand China Trust? First off, it's crucial to note that core of CapitaLand China Trust, its retail operations, which represent almost 70% of its assets, is showing strong signs of recovery. This mirrors the success of CapitaMall Trust or CMT, CapitaLand's first REIT listed in Singapore. If you are as ancient as me, you may recall that CMT was the REIT to watch every single results announcement. Their management of shopping malls was unparalleled, with superb strategic enhancements and positioning driving distribution growth. I believe this is what we can expect from malls under CapitaLand China Trust. Yet, the primary challenge has been the weakening of the RMB against the SGD, a significant drag on performance. This is driven by the current economic headwinds in China, including the effects of a real estate downturn. Navigating the aftermath of a real estate bubble burst is complex, given its extensive impact on the economy and consumer spending. Yet, there may be a silver lining. There's chatter about policy shifts and government support aimed at bolstering the economy. Let's get straight to the point. Despite the tumultuous journey and the uncertainty of hitting rock bottom, my dedication to CapitaLand China Trust remains strong, mainly due to the underlying strengths in its operational performance. That's right, I'm not backing down, but moving forward with a strategic approach. Considering its already significant share in my portfolio, I'm choosing to hold on to my CapitaLand China Trust investment, enjoying the attractive dividend yield of over 8%. This approach not only provides a steady income stream but also allows me the flexibility to wait for an upturn in China's economic landscape. For those already holding CapitaLand China Trust, like me, patience could be key. And if you're contemplating jumping in, stay vigilant for signs of recovery. It's a bold move, but sometimes, the greatest opportunities come from weathering the storm. Wrapping this up, investing has its ups and downs, That's just part of the game. With CapitaLand China Trust, we've seen both, presenting both challenges and moments of optimism. The key lies in maintaining a level-headed approach, especially in turbulent times. By focusing on the long-term potential rather than short-term fluctuations, we position ourselves to weather the lows and capitalize on the highs. Remember, resilience and strategic patience are your best allies in turning potential downturns into opportunities for growth. Let's stay the course together, embracing both the ups and downs as part of the broader journey towards financial wisdom and success.